The topic which has been selected and provided has been very important for the professionals to really understand. And before I start further, I am thankful to each one of you for being here. I know it's a working day, and 5 p.m. is a time where everybody has to really see that they are able to complete the task. So, not taking further time, let me share my presentation, and then we will discuss on today's topic. So, dear friends, as we can see, the topic it's learning from key observations by NFRA. And let me just give brief background of this NFRA. It stands for National Financial Reporting Authority. This has been constituted by way of Section 132 of Companies Act 2013, and it was constituted on 1st October 2018. So maybe this is a 5 years completion of one of the very, very important regulatory body. And after completion of 5 years, if you just look at, there are a lot of reports, orders have been issued, which are available on website of NFRA. So today's main objective is to learn from whatever has been already available on the website, and how can we really ensure that the quality of financial reporting can be increased from where today we are. So before I go further, let me provide a brief disclaimer. The information which has been provided here has been taken based on the documents and reports which are available from public domain on website is nafra.gov.in. The objective of presentation is to more on information sharing to ensure that we all can come together and learn towards the objective of financial reporting, increasing quality of financial reporting. So please go through the disclaimer. Neither the partner nor the firm or anybody has been the warrant information which is provided here is accurate or complete and disclaimed, and no responsibility whatsoever for the interpretation of the information provided here. With this brief background, let me just go further and provide you the brief oversight of the information which is available. See, there are a few review has been done by NFRA. Primarily, there are two reviews. One is a financial reporting quality review, and second is an audit quality review. Now, the objective of FRQR is to take certain financial statements for the purpose of review to understand that what is the quality of this review. So we need to really go back and look at section 132 2B of Companies Act 2013. Section 132 2B, which mentions that NFRA's main objective is to monitor and enforce compliance with the accounting standards and auditing standards. So as part of that particular, the objective to achieve the objective of compliance with accounting standards and standard of auditing, the FRQR and audit quality review, these two has been conducted by NFRA. Obviously, there are also various other inferences which is received by NFRA, which may be the reference from the register of companies, reference from SEBI, or reference from other government agencies. So FRQR, audit quality review, AQR, these two are independent. It is in addition to the other reviews which has been done by NFRA. So these are the four FRQR which are already available on the website. That is recently, that is on FRQR on PSP projects. Then ISGC Heavy Engineering Limited. Then on 14th February 22, that is on Prabhu Steel Industries. KIOCL review. And just look at, there are 5 AQR reports which are available. That includes with respect to ILNFS, ITNL, GEL, IFIN, 2 IFINs of August 20 and December 19. So these are the few reports available. And as I mentioned that this particular presentation is not talking about only FRQR or AQR. However, the object is to take few instances which have been observed by way of these reports and also the orders which has been there. It is not a complete like listing or comparison of the observations, because there are a lot of observations are available. However, try to pick up few observations for the purpose of understanding and learning, so that we can know that the repository of information is available, is already on their website, and we can, how can we use it, that depends on all of us. So the today's topic, I have tried to like comply or classify the observations to various domain, which includes non-compliance with Ind AS, that is one. Then non-compliance of standard of auditing, and then other non-compliances which may be pertaining to the Companies Act 2013, Code of Ethics non-compliances, and the lapses in engagement quality control review processes. So these are primarily overall understanding of the various non-compliances which are being generally noted in by way of the quality review reports or by way of the orders which has been issued by NFRA. Let us first look at few non-compliances with respect to Ind AS. One is on impairment allowance. The Ind AS 109, which talks about is creating impairment allowances by our expected credit loss model, ECL. So when you just look at this requirement, the ECL is required to be calculated on the financial assets. Now, in one of the case, what happens that the impairment loss allowance was not carried out. Now, on asking the questions to the corporates, it was responded that in these particular cases, there is no impairment loss because of the history which the company has seen. In the history, there is no ECL, there is no provisioning, there is no impairment was being done. As based on the history per se, the company has concluded that there is no need to create impairment loss for these particular things, which includes trade receivables, other financial assets. Now, it has been noted that we just look at Ind AS 109. I'm trying to focus few very, very important paragraphs in addition to what has been already noted here, with the objective to really give you a basic idea about what is to be referred into and how it is been referred into when we just look at the compliance of accounting standards. It has been noted that paragraph 5.5.4 of Ind AS 109, it mentions that while determining ECL, while determining requirement of ECL, one has to consider all reasonable and supportable information, including that of forward-looking information. So if anyone concludes that only on the basis of historical data, we cannot say that the ECL cannot be created or should not be created. Along with historical data, one should also look at the forward-looking information to arrive at whether there is a need of ECL or not. Just look at paragraph 5.5.5 that mentioned that credit risk, if increased significantly, then it should have impact with respect to the credit loss allowances. And paragraph 5.5.17, which talks about measurement of ECL, it mentioned that for the purpose of measurement of expected credit loss, various factors has to be considered, and that factors includes unbiased and probability weighted amount. So the amount which has been computed by way of the ECL should be unbiased and it should be probable weighted amount. Time value of money should also be considered, and there has to be a reasonable and supportable information available for conclusion of creation or non-creation of impairment allowance. So that provides a lot of information that the expected credit loss has a more of scientific way where one is to look at the various angles. It's not only of the history, it also talks about looking into the forward-looking statement, and also one has to look at various other factors, which includes the credit risk assessment. It includes a time value of money, reasonable and supportable information that is available for that. That all has to be considered when somebody conclude on requirement of impairment allowance or not. So in this given case, the impairment loss allowance was not done on trade receivable, other financial assets. the company has not examined the credit risk and has not calculated the expected loss as required by Ind AS 109. Now, taking another point, there was unbilled revenue. Now, for unbilled revenue, there was a lot of discussion was going on whether unbilled revenue, whether the company is required to create ECL on unbilled revenue. The contention of the company was such that the unbilled revenue is governed under Ind AS 115. Now, under Ind AS 115, it is governed. In that case, Ind AS 109 may not be applicable. However, this is applicable because Ind AS 109, it even talks about recognition of ECL on contract asset. If you just look at paragraph Ind AS 109, talks about that one need to create also on contract assets, and unbilled revenue, which is originating from Ind AS 115, is one of the contract assets. That's why ECL recognition is also applicable in case of unbilled revenue. Next point, let us look at Ind AS 19 employee benefits. The partial disclosures. The employee benefits has been one of the most complex and very, very important as far as the disclosure requirement is concerned, because the employee benefits and provisioning for that has a lot of information on actuarial valuation. So in this particular case, what happens that from the notes on account, it was mentioned that the company has a pension liability. On asking a question, the company, it was being told by company that it was a pension liability, a terminated pension liability. Thereby, this has not been provided. Now, the information as such is required that whether the terminated pension liability is a defined benefit plan or it's a defined contribution plan. And if it's a defined contribution plan, then there's a disclosure requirement of paragraph 135, which requires to provide information about this particular plan that has not been provided. So again, it says that not made the required disclosure for employee benefit pension in accordance with paragraph 135 of Ind AS 19 regarding defined contribution plan. So first of all, there was no mention, is it a defined benefit plan or defined contribution plan? But as per the information provided by the company, it was for a terminated pension liability. And if it's a defined contribution plan, the information which is required by paragraph 135 was not been provided. One very, very important thing which we need to understand that when we just look at the review of financial statements, it has been reviewed from the user's angle. As a user of financial statements, which information should be provided, how the users review and take decisions based on the disclosures provided under financial statements is one of the most important guiding factor. Come to the next important point, that is on the non-disclosures of acquisition transactions, Ind AS 103. There was a note which talks about and providing information about the acquired overseas company. A company has acquired one overseas company through one of the wholly owned subsidiaries during the year, but the disclosure of these transactions in the consolidated financial statement was inadequate. So the disclosure was provided. However, the adequacy of information which is required as per Ind AS 103, it was being questioned. And when you just look at Ind AS 103, paragraph B64 and B67, there are a few paragraphs where it talks about the provided disclosures, and the NFRA has noted that paragraph B64, clause E, clause D, F, G, H, J, N, P and Q has not been provided. And as far as the paragraph B67 is concerned, clause A, suppose 1 and 2 has not been provided. See, my objective here is not to go through that disclosure at these junctures, but however, to look at the expectations of the users, that we need to be very, very comprehensive as far as the disclosure is concerned. We need to look at and tick mark and go through that whether the disclosures which has been provided in this particular standard has been provided or not provided. It is not about just providing a one or two information. It is about ensuring the completeness of information is one of the very important things. Just look at another point which mentioned that there was another overseas company that was so acquired was in distress due to financial difficulties. Now, the question which was asked is that if a company which has been acquired in the year, during the year that was in distress due to financial difficulties, then whether the impairment has been done or not done. So there was no evaluation impairment as far as that particular company is concerned, and the information thereof was missing in the financial statements. That is what has been noted here. Come to the next point, that is on 115. So Ind AS 115, which talks about revenue from contract with customers. Under Ind AS 115, there are a lot of information which need to be disclosed. In given a case, it was noted by the particular report that the significant payment terms, obligation for returns, refunds, and other similar obligations are not disclosed. See, para 119 of Ind AS 115, which provides the list of disclosure that is to be provided under financial reporting. Now, para 119 talks about a lot of information. Out of that, the partial information was provided, how the full and complete information was not being provided, and that includes a significant payment terms. So again, we need to see that whether the payment terms which are being there for a particular company are they significant enough for the users of financial statements to understand. If so, that has to be provided. Again, there was a mention in the accounting policy notes and accounts about the input method that is being used by the company for the purpose of revenue recognition. However, this particular para 119 says that you should also include the disclosure that why the input method used provide a faithful depiction of the transfer of goods and services. That is what is not only input method, but also the why input method is providing a faithful depiction, that both need to be disclosed under the financial statements. So that is what has been taken as a negative observations by the NFRA. To next important point, that is on corporate guarantee. When it was referred to the notes on accounts, it was noticed that the corporate guarantee was given to banks to secure credit facilities to 3 of its subsidiary companies. So the financial statements has all the information. It says that the corporate guarantee has been given. Now, when it is referred to Ind AS 109, Ind AS 109 provides the guidance on accounting requirement for corporate guarantee. However, there is no such disclosure provided about, or there is no accounting has been done for corporate guarantee, because for financial guarantee can be two. Either it can be performance guarantee or it can be financial guarantee. Performance guarantee is need not to be accounted. Financial guarantees has to be accounted, and Ind AS 109 provides the guidance, and that particular thing was not being done during these particular requirements. Come to the next important point, that is on the disclosure of government loan. So company has taken a loan under a government scheme in which a part of the interest shall be borne by the government in the form of interest subvention. So what was the situation where there was a mention in those accounts about the government scheme which has been applicable to the company, and the company has taken a loan where some part of interest is being borne by the government. Now that is a government benefit, government scheme, by government grants, government benefit which is being received by the company. Ind AS 20 provides accounting treatment, and also it talks about the disclosure which is being provided by the company. Here, when you just look at the paragraph 39 of Ind AS 20, it says that the company should disclose accounting policy, including method of presentation adopted in financial statements. So just providing accounting policy is not sufficient. One also has to provide, along with accounting policy, what is the method of presentation of this particular government grant in financial statements. Also, it talks about nature and extent of government grants recognized in financial statements, unfulfilled conditions, and other contingencies, if any, arising from this government grant also need to be provided. So this has not been disclosed adequately in the financial statement. That's why the NFRA has made it as a negative remarks. Next point is on employee benefits. It was not clarified in the financial statements regarding the bifurcation of leave encashment into long-term and short-term. See, Ind AS 1 paragraph 65, which mentioned that the information on expected date of recovery of non-monetary assets and expected date of settlement of liability such as provisions shall be provided. Paragraph 110 mentioned that to inform users of measurement basis used in financial statements. Now, in these particular things where the bifurcation of leave encashment was not provided long-term, short-term, plus the measurement basis used for the purpose of a short-term leave encashment was also missing in the notes on accounts. So that need to be provided here. Next important point that was on contradictory GAAP disclosures. So, we need to look at that the whole annual report is one piece of information for the user's financial statements. They all need to be synced together. Some information is provided under data's report, which is different than the notes on accounts. Management discussion analysis says differently than what is there in financial statements. So all the information which is provided as a one set as a part of annual report should be interconnected, and they should provide the same information so that the users of financial statements are not confused. In one of the company, what happens that data's report state the companies follow accounting standards. How notes and accounts talks about in compliance with Ind AS. So these are the few things where we need to look at that the all informations, even the figures are there. Sometimes the figures which is provided in data's report and figures which is provided under the financial statements, they should all be in sync. Statement of changes in equity. In one of the company's case, what was happened that they have disclosed schedule or notes which talks about the share capital and a reserve and surplus. However, there's no specific statement for the statement of changes in equity. So wherein it was being pointed out that even though the information which is provided under share capital reserve surplus maybe partially is able to satisfy the requirement of changes in equity. But please understand that the financial statements under Companies Act 2013, which is defined, it includes a statement of changes in equity as a separate statement. So for Companies Act 2013 point of view also, there's need to provide a disclosure of these things. Plus, if you just look at the changes in equity statement, it also provides information about the classification of profit and loss and other composite income, and then the movement is provided. In the notes on account schedules, share capital reserve surplus, it does not provide that particular movements. So that's why that is not a compliance of the requirements. Disclosures, the income tax and related accounting policy erroneous. So these are the few pointers which has been taken in one of the companies where the disclosure which has been provided have been erroneous. For example, when you just look at accounting policy of income tax, it mentioned that the deferred tax has been provided without timing difference. Under Ind AS, it is a temporal difference, and that's why the information which is provided in the accounting policy should be in sync with the requirement, because the accounting policy is very critical, very important. It provides information about the how the accounting is being done. It cannot be taken as lightly as only the piece of information which has been copied pasted. So the income tax and related accounting policy erroneous. Inadequate disclosure of India's 19 employee benefits. As I mentioned earlier, that employee benefits has been one of the very important thing where a lot of disclosure has need to be provided, including assumptions therein, and also how it has been counted. Is it a short-term, long-term, post-employment benefit plan, different benefit plans, different contribution plan? Then under India's 7 cash flow statement also, there is a need to have a specific disclosure for para 45, 46, 48, which talks about the cash flow statements related that is not provided. India's 107 financial instruments and India's 130 parallel measurements, there will be inadequate disclosure. So see, financial instruments is one of the very complex Ind AS 107 provides a detailed information about what is to be provided, and 113, which mentioned about the fair value measurement, layer of hierarchies. So there are a lot of detailed information required to be provided in these two standards, so which need to be provided here, which is not there in that particular case. There have been incomplete disclosure requirement for the property plant equipments. There was an associate for a company. However, the consolidated financial statement was not prepared. It was argued by the company that the company doesn't have subsidiary company, it has only associate in the picture. That's why it is not done. But as far as the Ind AS is concerned and ES is concerned, consolidation is compulsory even though you have only associate. So the consolidated financial statement was not prepared. That was again non-compliance here. Coming to a few other points which talks about the loans and advances. In one of the case, what was happened that the loans, the no disclosure of loans, nature of loans is given. So the nature of loan is something which is need to be provided. You can't have only one heading saying loans and advances, because the Schedule 3 talks about providing the nature of loans. Deposit of taxes and duties with government disclosing current loans and advances. Others, which is not a financial assets. So that is again incorrect the way it has been provided. Depreciation was not being provided for plant and machinery. So Ind AS 16 talks about the provided depreciation. It says that you need to provide a charge in profit and loss statement based on the useful life of the assets. So not providing depreciation where it is available for use is not a correct compliance of the accounting standards. Other non-compliances, which includes deferred tax assets recognized even though no audit working paper of reasonable certainty. There are certain cases where the standard says that if you are having the carry forward losses or like depreciation not being taken appropriately, brought forward losses are available. In such case, there has to be a reasonable certainty. So the audit working paper should be able to speak about having this kind of reasonable certainty. Earning per share was wrongly calculated, or the information which is provided in the notes of accounts has not been appropriately tied up with respect to the number of shares which is disclosed and earning which is there. Depreciation method, SMWDV, has been not mentioned in significant accounting policies. Non-recognition of retirement benefits. Why it is not recognized? There's no mention of as a reason of non-recognition of retirement benefits. Even though company's employees' salary has been there, but retirement benefit was not being provided. So what is the reason behind that has not been appropriately disclosed in those accounts? So that provides you a brief overview of the Ind AS related standard of Ind AS related issues. As I mentioned, that the objective of this particular thing is to just touch upon the few. There are many observations which has been provided, and this just provide you a glance over what has been there in various reports. Let us now look at the standard of auditing. The few essays which I have referred is on audit documentation, forming an opinion on reporting on financial statements as a 700, use of work of management experts as a 500, as a 620, communication with those charged with governance as a 260, and other relevant standard of auditings has been covered here. As I mentioned earlier, that there are two kinds of reviews by NFRA. One is of financial reporting quality review, and second is audit quality review. In financial reporting quality review, the objective of is to review the financial statements from the preparer's angle. In audit quality review, the focus is to look at the audit working papers and the compliance of standard of auditing. So the audit quality review has been more focused towards the quality of the audit which has been done, the quality of audit documentation, and the compliance of standard of auditing. In one of the cases, there has been the lapses in the audit of investment which is noted. Basically, total value of investment was on March 18 was 50% of its balance sheet size. So these just provide indication that the investment has been very important material things for the financial statements. Now, what is noted that assets 2 to 30 audit documentation has been violated. the NFRA has asked to provide the board approved investment policy. However, it has been provided, but it was not in audit file. So basically, so without approved investment policy, it was being asked that how can you as an auditor verify whether investment was made by the company as a policy or not. So your audit documentation should have the board approved investment policy, and based on approved investment policy only, you can verify that whether the investment has been made is in compliance with the policy or not. So that is one of the very important documents, considering that your investment in the company is of a very significant amount, which is material amount. Next point, that no evidence was found that the management has tested each investment for impairment. So as we mentioned, that investment was very important size, and the impairment testing is critical aspect. So there has to be working paper available which mentioned that the whether management has tested or not. So that working paper was not found in particular cases. Yes, in majority of the cases it was identified, but it was not available for each investment, and how that particular signifies that was not available. The working paper was not available with respect to audit procedure made for 1,637 crore of investment. In many cases, it was noted that the auditors relied on the valuation which is done by the experts. So SA 500 and SA 620, which need to be complied with it, it was noted that there's no record of objective evaluation as to whether the competence of expert was examined, vice versa, his previous experience in dealing with such subject. So what I mentioned that basically the auditor need to check that the expert which has been doing this particular valuation, that the expert has done similar kind of assignments earlier. What is the team which is involved into that? What is the experience of the team which is involved into that? That kind of interaction, that kind of documentation was required, which is not there. So A30 of SA 620 again talks about two-way communications. Second point was that there is no evidence in the audit file which signifies a two-way communication that took place between the audit firm and auditor expert. So if an expert has been there which is issued a valuation report, that whether the company, whether the auditor has done the two-way communication about asking the assumptions taken, then do the expert has a conflict interest or not, understanding the scope and responsibility of expert. So that kind of information or documentation was not available in the records. Lapses in the audit of loans and advances. Now here there is again mention about failed to obtain sufficient appropriate audit evidence SA 500. Sufficient appropriate audit evidence SAAD is one of the very important crucial things in the whole audit. Probably the audit may have been done, but however, if the documentation is not there and the documentation is available, it is not sufficient, it is not appropriate, then also it is not being complied with it SA 500. So what was noted that the duly approved credit policy was not there in the documentation. The auditors failed to review the lending policy of the company, thus violating the requirement of SA 500 and para 6.23 of ICAI's technical guide on audit of NBFC. That company was NBFC, and the ICAI has provided a technical guide, and that technical guide provides some guidance on compliance with this requirement. So what NFRA has noted that you're not done as per the SF plus the compliance with the technical guide. The technical guide provided by ICAI is providing you the requirement what is to be complied with it. Point B, which talks about end use and evergreening of loans. So paragraph 5.6 of technical guide mentioned that verify whether there has been any window dressing, there is sanction of new loans to repay an existing doubtful loan. This method may be resorted to by the NBFC to cover up bad loans. There is a specific mention about this guidance. So it doesn't ask that why the auditor has not resorted to this particular guidance and to the particular audit procedures which has been expected from the auditor as far as technical guide is concerned. Para 18 of SA 330, it states that irrespective of the assessed risk of material misstatement, the auditor shall design and perform substantive procedures for each material class of transactions, account balance, and disclosures. So these are the few literatures which are already available and which provide you guidance. So what is expected that one has to refer and ensure that the working paper which is there, it speaks of compliance of standard of auditing. Materiality. Now, for materiality is one of the very important part which has been always been taken as the critical aspects, because the auditor is doing true and fair, and true and fair. For determining what is true and fair, very critical to understand what is material. So determining materiality is very, very important. In here case, the audit firm has determined materiality of 100 crore concerning 0.5% of total assets as of March 2018. However, there's no review of materiality working paper by engagement partner. Para 17 of SA 220. Now, para 17, what para 17 talks about? It says, on or before the date of auditor's report, the engagement partner shall, through review of audit documentation and discussion with engagement team, be satisfied that the sufficient appropriate audit evidence has been obtained to support the conclusions reached and for the auditor's report to be issued. So this paragraph 17 of SA 220, it casts responsibility on engagement partner to ensure on or before issue audit report that the all audit documentations are sufficient and appropriate. That includes the material level which has been defined here, and that gives comfort to the engagement partner that the all documentations are supporting to the conclusions which are reached by the auditor when the audit report has been issued. So that was there was no review of materiality by engagement partner, which is one of the very important part. So that is not done. Sign off dates reflects mere formality. When they just look at the audit documentation, they feel that the sign off has been done, but it looks to be only formality. There was no heart was gone into picture. In working paper mentioned, materiality has been calculated using a financial result of 30 September 2017 and the final financial results of March 2018 with the date of sign off for preparer and review before March 18. So when the date of sign off of preparer and reviewer is there on that was before 30 March 2018, how can one consider 30 March 2018 financial statements as a base for computation of materiality? So that suggests that the sign off which has been done is only for the purpose of formality, and that is not the actual the formality. Otherwise, the date of sign off should be after the result of March 18. Factors considering performance materiality is not documented. See, material has been computed, but which factors has contributed to that particular thing has not been there. So that has been missing here. Coming to next point, there is too many EOM. EOM is emphasis matter. In one of the particular audit report, it is observed that there are 8 emphasis matter. It has been noted that where there are many emphasis matters, it really actually loses the importance of emphasis matter. Emphasis matter means where you want to draw attention of the user financial statements to a particular point, you can refer to them. But when you're having a lot many emphasis matters, then obviously it is like referring to the notes on accounts, which is already part of financial statements. So para A3 of SA 706, which mentioned that the widespread use of emphasis matter paragraph diminishes the effectiveness of the auditor's communications. So the widespread use should not be resorted to for emphasis matters concerned. Then the objective of EOM has not been fulfilled. Then on combination of reading paragraph 5A and paragraph 6 of SA 706, the financial statement item on which EOM can be issued must satisfy the following. Now it provides guidance that we just look at these two paragraphs together. When EOM should be issued, you should satisfy the two conditions. One, the matter has to be appropriately presented or disclosed in financial statements. So emphasis matter is about reference. That means the matter has been appropriately presented or disclosed in financial statements. If there is no matter has been provided, there's no point of putting EOM. And second, the audit should have sufficient appropriate audit evidence. By just making reference, the auditor is not out of the scope. The auditor has to obtain sufficient appropriate audit evidences that the matter is not materially misstated in the financial statements. There was an opinion on IFC, internal financial control, and when the working paper has been referred into that, it says documented a list of questions for evaluating internal financial controls and pre-audit working papers, which contains engagement test of control carried out with respect to testing of purchases and creditors, stock, fixed assets, and sales and debtors. It was noted that it was merely a checklist, which is a column for questions on the identified significant accounting and separate column which provide answering yes, no, NA without any expression for the same. So checklist is really good. You should have a checklist. However, the checklist has been resorted into without application of mind, without application into real principles. It is not serving the purpose. So just a checklist with yes, no, NA without any expression thereof, it reduces the importance of having the sufficient documents that the audit process has been followed. No documentation was found in audit file to show audit planning. Audit planning process followed by audit firm on the basis of which significant account balance or disclosed items and relevant assertion. So when you just look at the audit planning mention about the significant account balances. However, once you identify significant account balance and assertions have been there, what the procedure has been done to satisfy yourself that audit procedure was not being observed. Working paper, no documentation of audit procedure applied and conclusion drawn. That was missing in the audit documentation. This all provides a question mark on testing of internal financial controls, because you may have the documentations with respect to checklist. However, unless until it has been done appropriately with respect to applying in mind the audit procedure which has been done, if it is not being done, it is not giving a comfort on that requirements. Risk of material misstatements. Not satisfactorily rebuild the presumption of RMM due to fraud in respect of revenue recognition and manual override of controls. It was discussed in one of the cases that if for revenue recognitions and management override of controls, you should have the documentation that says that there is no fraud. It is a reverse situation. In general case, what happens that if you have some kind of information available about fraud, you should go into introspect and identify. But however, with respect to revenue recognition and management override of control, it mentioned that the presumption of the fraud, risk of material misstatement due to fraud is there. If you believe that there is no such presumption, then your documentation should be such which removes that presumptions of RMM due to fraud in respect of revenue recognitions. So working paper was not supporting so performance of risk assessment process to provide a basis for identification and assessment of risk of material misstatement of financial statement and associated level is required. It was failed to obtain sufficient appropriate audit evidence to reduce RMM to an acceptably low level. With this going concern assumptions, in that particular company's case, there are several indicators were available in financials which raises doubt about going concern. Now, when there are doubts about going concern, as a 570 para 10 says that you are required to discuss with management the basis for intended use of going concern and inquire whether the event or conditions that exist may cast significant doubt on ability of the company to continue as going concern. So where the indicators are there, just several indicators which talks about that it is the it is the duty of auditor to discuss with management and inquire with them that whether there are certain conditions that talks about these things. So non-compliance of SA 570 failed to obtain sufficient evidence with respect to management use of going concern. Sundry balance is written off and missing expenditure. Profit and loss includes sundry balances written off of which 14.87 crore and other missing expenditure of which 24.6 crore. That constitutes 54% of total expenditure. So basically, when the amount is so much significant, that means that the auditor need to be more aware, and there has to be a specific procedure has to be done carried out to ensure that it has been appropriate. Non-compliance of SA 240 or the responsibility to fraud that was been there, and AS5 which talk about extraordinary item. These two things also need to consider as this amount considered 54% of total expenditure. So these both need to be so added appropriately. Related party transactions. So it is mentioned that the non-disclosure of all names and transactions of related parties, non-compliance of SA 550 and AS 18 was observed here. Non-current held for sale. See, in case of held for sale, Ind AS 105 talks about the case where if any non-current asset has held for sale, then it has to be reasonably expected that it should be happening within 1 year. Now, the reasonable expectation should be there. However, when you just look at in this particular case, the company has disclosed to BSE dated 31st May 2017 that it is expected to be closed by October to December month. The auditor has signed audit report on 19th May 2018. That is after 5 to 6 months of October to December 2017. However, still it was held for sale. So that suggests that auditor should have a detailed working paper so that how and why this has not been closed. When it has been referred to BSE that it will be closed by October, December, and even after completion of more than 5 months, it has not been done, then the audit working paper should be have a definite agreement, should have reviewed that the agreement, also should discuss with those charged with governance and management about the progress and the reason thereof of not doing that. But that was the missing in the working paper file. In case of documentation, it was observed in various cases that the backdate of documents were there. So the name and date given in staff matrix was not matching with the audit program. Somebody was there in matrix, but however, audit program was different. The documents which have been like taken were backdated. The hours which has been submitted in attendance sheet were mismatched with the audit program, plan, other documentation. So one has to be very cautious with respect to ensuring that the documentation is complete and they are appropriately on which reliance can be placed upon. EQCR process, engagement quality control review process, appointing the engagement partner himself as EQCR, not possible. Engagement quality review partner and engagement partner, they both are different persons, and then the role of both partners is different. So if somebody appoints himself as EQCR is not a correct thing, and that negates the very fundamental objective of standard of auditing. The data by transactions, just obtaining mandatory representation is not sufficient. In one of the case, the companies obtained MRL, which talks about the related party transactions. Then they are in all course of business, arm's length. So by just reliance on MRL is not going to absolve you from responsibility. There has to be adequate documentation available in addition to only MRL. That's sufficient that you appropriately perform the audit procedures for getting comfort over this list. So let us have just a few other non-compliances quickly because we do have time. Next 4-5 minutes we'll close it out. So that is on Company 2013 Code of Ethics and engagement quality review process. So Company 2013, when you just look at is a compliance of AS, IndAS, assay, Company 2013, other relevant rules and regulations. So there was no disclosure of purpose of loan to subsidiaries. The company is given loan to its foreign subsidiaries, which is a wholly subsidiary, but has not disclosed the purpose of giving a loan. what the management has like argued, that section 186 of Committee 2013, where it mentioned that if it is given loan to wholly owned subsidiary company, then there is some exemption. However, the exemption which is provided for wholly owned subsidiary company was section 166 subsection 3, 166(4), which talks about disclosure. There is no exemption in case the loan is given to all, which includes wholly owned subsidiary company. So disclosure requirement which talks about disclosing the nature and purpose of giving a loan, that is applicable to all loans, including wholly owned subsidiary companies, and that was not being complied with it. Schedule 3, compliance of Schedule 3 is very critical, which provides the formal financial statements, Division 1 AS, Division 2 IndAS. Others was mentioned, but Schedule 3 requires others to provide nature of balances for other item, which has not been provided. The non-compliances which is observed: short-term borrowing that is to be presented on face of balance sheet shown in note number 8 to financial statements, not on the face of balance sheet. DTA was classified as current assets. Cost of material consumed, purchase of stock in trade, and change in inventories has to be shown on face. How it was shown in notes and account, which is incorrect. Loan disclosure was incomplete, and classification of short-term borrowing and short-term loans is not given. So these are the few non-compliances which have been observed. The lapses in the audit of investments: no prior approval of authorization of RPT. Section 177 of Committee 2013. There's no discussion going on that whether there is a need to take prior approval or one can take post-factor approval. It was being discussed and deliberated and clarified by NFRA that section 177, which talks about the prior approval word is used, and that approval word means a prior approval. It allows post-factor approval only in some classes of cases involving relatively smaller amount, not exceeding ₹1 crore. So that particular it mentioned that section 177 talks about the post-factor approval only in limited cases, not in all cases. Fact to independence: if you are having the significant amount which is received by the state of the concern, which may jeopardize your independence, one has to be very careful. So the providing non-audit services, even though this is being provided by your brand name or associates, is in non-compliance with independence. Engagement quality control review, IQCR, paragraph 20 of SA number 20 state that engagement quality control reviewer shall perform objective evaluation of significant judgments made by engagement team and conclusion reached in formatting the auditor's report. So the documentation should be available, which talks about that EQCR has appropriately provided an objectively done evaluation of the significant judgments of the engagement team, and the conclusion which is reached by the engagement partners has been appropriately been done. So that kind of documentation is required to be have. I think with this, I am just ending up this presentation. The objective of this presentation is to really provide you the glance over the few of the observations which has been provided. A lot of literature has been uploaded on NFRA website. We should go through it by way of the reports of financial quality review reports, then audit quality review reports, also the orders which are uploaded on websites, and audit also will find a lot of information about why the negative stand has been taken by the NFRA, and these all things are really providing a lot of information for us to learn. Like same way ICI has done, that is on FRRB Financial Reporting Review Board, which is look at non-compliances which is observed by FRRB, and the comparison of the non-compliance are also be provided on ICI website, so that can also be referred into for learning point of view. So what we expect from that, if these non-compliances which are been there by way of auditor orders or by way of some these reports, if the compilation thereof is available, I think it will really serve as one of the very, very important learning tool for a lot many professionals and the companies to really learn on that. Another part which I would like to mention that yes, the work which has been done by has been very, very important to ensure that the quality of financial reporting is intact, but it has also caused a fear. So in my view, along with the fear on auditor, there's also need to have fear on the management, because the auditor really act as the detection or deterrent. But however, if there is fear on management, then I think it will also act as a prevention for the management to ensure why the standard of auditing, why the Ind AS compliance, why the compliance laws regulation is critical. That kind of measures should also be taken. But however, we must appreciate that a lot of work has been done and a lot of things to be done by professionals and management to ensure that we really increase the level of compliance. We should increase the level of quality, and together, all of us, including the FRA and professionals, together we all should ensure that the quality should increase. Lot need to be done by many professionals, including me, and we all should strive ourselves based to ensure the compliance and the quality of reporting has increased. So with this, I end my presentation, and thankful to Taxmann for providing the opportunity for sharing my views on this particular part. Let me see if you are having any questions. Okay, Naveen Chindaji, thank you so much for your feedback, and I hand over the charge to Taxmann for taking this further proceeding. If there's no questions, I think we may hang up and close this presentation. I'm thankful to each one of you for being interactive, participative, and let us all come together and ensure that we increase the quality of reporting. So with this, I end my presentations. Thank you.